You're watching now. The latest World Economic Outlook released by the IMF estimates the world economy will contract by 3% in 2020. That's the calendar year, much worse than in the financial crisis of 2008-2009. If the pandemic fades in the second half of this calendar year and containment efforts are gradually lifted, then the forecast for 2021, which is next year, is 5.8% growth. This is for the global economy. For India, the forecasts are thus: 1.9% GDP growth for the financial year 2021 and 7.4% growth for the financial year 21-22. This, of course, comes with a bunch of caveats. To discuss this, I'm joined this evening by Gita Gopinath, Chief Economist at the IMF. Gita, thank you very much for joining us, and good to see that you're well.
Thank you for having me on your show.
Gita, I know that this is a very difficult set of forecasts to make. I've read through the report and the many conditions and caveats that you all had to put in, given the unpredicted nature of this crisis, the unprecedented nature of this crisis. Now, there's one particular sentence I'd like You're watching BloombergQuint. Now, the latest World Economic Outlook released by the IMF estimates the world economy will contract by 3% in the calendar year of 2020, much worse than in the financial crisis of 2008-2009. If the pandemic fades in the second half of this calendar year and containment efforts are gradually lifted, the forecast for 2021, which is next year, is 5.8% growth. For India, here are the numbers. The forecast is 1.9% GDP growth for the financial year 2021 and 7.4% growth for financial year 21-22. To discuss this, I'm joined by the Chief Economist of the IMF, Gita Gopinath. Thanks very much for joining us, Gita. We had a false start in this conversation earlier on because of technology issues. I'm glad to see you well. And I'll get on quickly with my first question. And that is that you've explained how uncertain the current scenario is and how difficult, therefore, it is to make these forecasts. There's a line in your report that interested me. You've said a partial recovery is projected for 2021 with above trend growth rates, but the level of GDP will remain below the pre-virus trend with considerable uncertainty about the strength of the rebound. Now, one of those uncertainties, I'm sure, is the timeline. What have you estimated in terms of timelines and various scenarios?
Hi. Yes. So we've the baseline, the number that you quoted of -3%, assumes that the pandemic crisis peaks in the first half of this year, and then you start seeing containment measures coming off gradually in the second half of this year. And by the end of the year, we are in the clear and into 2021. In that scenario, we have -3 for 2020, and then we have 5.8, like you mentioned, for 2021. But again, to be very clear, because people see a number like 5.8 and they think that that's a real major rebound, it is still, economic activity is going to be still well below what we had projected pre-virus. Now, there are alternative scenarios where the crisis goes into the second half of this year and even into 2021, and we have built those scenarios. Those would be cases also where the financial crisis would be just that much worse. In that situation, we would have global growth for 2020 at -6%, and then 2021 growth would be basically around 0, which means that there will be hardly any recovery. So these are the kinds of scenarios that we built in there. I think we are very clear that there is tremendous uncertainty around the forecast.
One of the things we all have to consider, given the experiences of some countries, is the potential of a second outbreak. Is this factored into your scenario numbers? And how much worse does it make the numbers if that were to happen, let's say, in the second half of this year?
Yes, indeed. So the scenarios that we have exactly consider this situation where you have a second round that comes about in the second half of this year. And in that scenario, we're talking about a doubling of the contraction, which is instead of being -3%, we will be down to -6%, which is, of course, getting now even closer to depression levels.
Okay. The other uncertainty I was, interested in getting your views on was how demand recovers. Let's assume that we are done with the worst of this crisis in the first half of this year, as one of your scenarios points out. And in the second half, we can see containment measures or lockdowns being lifted and, business come back to normal or as close to normal as possible. There are going to be behavioral changes, as you've pointed out, based on a variety of different things. Can you talk us through how you approached demand recovery?
When we think of demand recovery, of course, there is the traditional piece, which is that in the peak of the pandemic, we will have a substantial rise in unemployment in many parts of the world. So the question is, how quickly will firms start rehiring workers? How quickly will firms start going back to business as usual? We've taken that into account. Of course, it varies across countries. Some countries rely much more heavily on the kinds of sectors that depend on social interactions like tourism and entertainment and travel, while others depend less on it. So there's variation based on that. But one of the policy recommendations we make is that once you're in the recovery phase, countries should be providing, for instance, hiring subsidies for firms so that that moves along much more quickly. And the other recommendation we have is for countries that have fiscal space to do kind of a broad-based fiscal stimulus. A broad-based fiscal stimulus does not work now in the period of containment, but it will work once we're past the containment phase. And this would include, infrastructure projects, things of those kinds. And that would be another source of demand. So public sector demand will have to remain high even in the recovery.
So is it fair to assume that, let's say, for the next several quarters, once the worst of the pandemic is behind us, it will only be government spending that will drive the world, right?
Well, that alone cannot do it. I think we need government spending also to support the recovery, but it's not possible for that to be the only channel. The recovery will have to come from a resumption of all kinds of consumption activity and in terms of firm hiring. Investment tends to respond with a lag, and especially in this environment when there is so much uncertainty, if there could be another round of this pandemic. So I would expect investment may hold off in terms of the private sector investments, and that's where public sector investment can play a role.
Do you believe that both governments and central banks across the world have done enough? I know that you all have put some numbers out, spending and revenue measures at the global level amounting to about 3.3 trillion, loans, equity injections and guarantees amounting to about 4.5 trillion. It's quite clear that both governments and central banks have, in fact, this time around reacted rather quickly, as opposed to, let's say, the gradual way they reacted in the global financial crisis. But have they done enough?
No, that's right. They've really moved much more rapidly. Now, this is not uniformly across the world in terms of the scale. So it's a total of about 8 trillion discretionary fiscal stimulus in the world, of which 7 trillion is from G20. And again, among the more richer nations of the world. The impact that we're seeing, if you look at unemployment numbers and retail sales numbers that are coming out, are just really dire and severe. And you're already seeing governments announcing additional stimulus packages. So I expect this number will grow. I think the bigger concern is of the developing countries and emerging markets that have lesser fiscal space, that cannot as easily borrow as cheaply as many of the advanced economies can, and therefore are more restricted. And for them, it is very important that they have access to concessional financing. And it's also very important that for poorer countries, that debt service relief is provided at this time.
Fair enough. Before I get to developing and emerging economies, I do want to ask you a little bit more specifically about what central banks have done, especially in the West, and especially to do with swap lines opened up by the Fed. How effective, in your understanding, has this been? Should we anticipate more such measures in the weeks and months to come? And where do you see some of the hidden risks?
This crisis has, one of the things that you've seen play out is this rapid tightening of dollar liquidity in international markets. And to ease that, the US Fed, triggered its swap lines. Some of them were from the previous time they did this, was during the global financial crisis, but they also extended it to a couple of countries. My sense is that if this crisis takes a turn for the worse, and even if it doesn't, I think that we could have a situation there could be even greater demand for dollar liquidity in international markets, and that would require international support for it. So at the International Monetary Fund, we are, in fact, thinking of a short-term liquidity line that can serve some of that purpose, in addition to our flexible credit lines that we have. But there will be probably more need and more demand for other kinds of facilities.
This line that the IMF may extend, or any further action by the Fed, do you think it will broaden the kind of securities that will get purchased? We're already hearing a lot about the Fed, being open to buying junk in the last few announcements that they made, just to be able to keep corporate debt markets, in some sort of stable control. What would the IMF line help with? Would it help countries like India? Can you talk us through a little bit more about that?
So, what this crisis is doing is that it's pushing otherwise viable firms to become non-viable, and that's the kind of situation we don't want to allow, because many of these firms that are now in the just slightly below investment grade were well above investment grade, and this crisis just brought a collapse in revenue for them. That changed their prospects. And that's nothing to do with bad management of these companies, but it has to do with a completely exogenous shock. So it makes a lot of sense for central banks and policymakers to support more broadly than they would have done in the face of other kinds of crises. I expect that institutions like the IMF, and that's what we're doing, we have about 100 countries that have approached us for financing. We are providing rapid financing for them, and to make sure that we meet the needs, which we think are about 100 billion at this point in terms of rapid financing needs. We have actually increased access to our rapid financing facilities so that we can provide the necessary support. And like I said, we are also providing debt service relief to our poorest member countries. We just did that for 25 member countries. But these kinds of measures will be needed.
Okay. Are you concerned, as many other people are, about potentially lurking risks in the shadow banking industry? Now, whether this is, what we call NBFCs in India, or it is alternative asset managers across the world, or even private equity. It's not very clear how tight liquidity conditions are there and what the implicit risks could be. Is that one big area of concern for you as well?
We were concerned about this even before the virus hit. We've been flagging that in our global financial stability reports, where we talk about risks building up in many parts of the world in the non-banking sector, kind of the non-regulated ones. This is the corporate sector, but also NBFCs. That concern has just gotten manifold at this point in time. Now, the priority, of course, for governments around the world is to do the spending it needs to do on the health side and to ensure that people and firms are maintained so that when we're in the recovery phase, that we can go back to normal as soon as possible. But regulatory agencies will have to keep a very close eye on these kinds of developments that we will see in terms of non-performing loans, in terms of deeper stress in the non-bank financial sector, and they will have to address that. Think of a plan of how to address that as we get out of the peak of this containment period.
Okay, can you think of, are there unconventional measures that would be on your list that you'd expect central banks and maybe even governments to resort to be able to address these risks?
Well, I mean, you've seen the kinds of measures that are being taken by major central banks around the world. Now, yeah. I think what we've seen this time round is a much more closer working of fiscal and monetary policy, because this crisis has called for all hands on deck. And so, for instance, in the US, what's happening here is you have the Fed that's doing the lending, but it's backstopped in terms of credit risk. The credit risk is on Treasury, because that's not something central banks can take. That kind of a collaborative step, I suspect, is going to roll out in other countries of the world. But these are the kinds of measures that will be needed.
Okay. India and China, the only two countries where you not forecast rather, a contraction in 2020 or FY 2021, depending on which country follows which year. Let me talk about India first. Is this based on the current level of virus spread in the country and of fiscal and monetary support, which is very marginal, that's come in so far? Or have you factored in more in these forecasts?
So, I mean, there are other countries too where it's positive, but if you look at the larger economies, you're right that India and China are the ones with positive growth, unlike the others. Just a couple of things to flag, and I think one is what you mentioned, which is in terms of the severity of the health crisis, right? We are not seeing the severity of the health crisis as we see it in Europe and in the US, and as we saw it in Wuhan in China. So, we've assumed, of course, that things would be worse on the ground than what we're seeing currently. But I think there could be much worse scenarios. So in terms of downside risks to our forecast, I actually think some of the biggest ones are for emerging and developing economies. And of course, another thing to mention in the case of India is that it's fiscal year numbers and not calendar year numbers, which is what we have for many other countries. So if you did calendar year basis, India number for 2020 would be 0.5%.
And this factors in the current level of fiscal and monetary support that's come in, because so far the government's announced a very, very tiny program of support. And many of those measures, Gita, are measures that were already existing schemes, except that they've advanced some of them. So are you anticipating more support?
So we've incorporated in our forecast the support, obviously, that's been done. We are also anticipating that there will be more monetary stimulus in the sense of rate cuts and other kinds of measures. And we also see scope for more being done on the fiscal side to support households and firms.
Can you talk us through what your assessment of India's response has been? I mean, Do you think that we currently run the risk of having done too little? I think there was a fiscal monitor report out by the IMF that said in India the fiscal stance should be eased as needed to accommodate necessary increases. What's your view on how much we can, at this point in time, relax the fiscal deficit measures, and to what extent should the Indian authorities go to be able to support the economy?
So we strongly support the policies that are being done. I think it's the number one priority is health and people's lives, and the lockdowns are helping contain the spread of the virus. And there was a very quick response on this front, and that's very welcome. At the same time, of course, when you're in this phase, you have to ensure that people have their basic livelihoods. When it comes to daily wage workers, you saw, migrant workers, you have to make sure that they have the support that they need. And also that firms, and especially small and medium enterprises, are able to survive this crisis to restart again. So on that front, there has been spending on both people and on firms. We see scope for more being done, and I'm sure that this is being considered in the next weeks. In terms of the monetary policy, of course, the support through liquidity, through dollar swaps, through encouraging lending to small and medium enterprises. I mean, all of these are important steps, and depending upon what you see on the ground, you might see more action. I mean, the RBI has given forward guidance that they will do more in the future.
Sure, but I'd still like your views, on how much more India should be doing. Should we be looking at deficit monetization? Should we go that far, or do you believe that the very sort of the very linear, targeted measures that the government has announced so far should continue to be the route that the government takes, and not considerably expand, spending or the deficit?
So, I'm being very clear by saying that more needs to be done, which means that we're talking about more fiscal stimulus. To your question of whether that should be done through monetization, that jumps the gun a bit, because that assumes that, that's assuming that the government is not able to borrow in domestic markets or international markets at any kind of reasonable rates, and that's not the case for the Indian economy. So there is that space that exists, and we can absolutely see the kind of close collaboration that we're seeing everywhere in the world between monetary and fiscal policy to support the broad mandate of keeping unemployment low and economic activity in reasonable shape. So, those kinds of measures are what I would expect to see. Monetization is, a last resort measure because it has some, very, very negative impact on things like inflation expectations and on institutions going forward. So I think there's a lot more that can be done before India gets there.
And you think that the world would look at maybe, let's say, an expanded deficit by at least another 100, 200 basis points, if required, comfortably, given the scope of this crisis and the impact on all nations?
So this is a crisis that's a global shock. Every country is experiencing it. It's a clearly recognized exogenous shock for countries. So India will be no different in that matter, which is you're seeing build-up of deficits and debts in many countries in the world. And again, this is not something specific to India. So I think the treatment will be should be the same. Now, what is very important, and this is advice we're of course giving to all countries, that do the spending that you need to do. And like Vitor Gaspar just mentioned today in the fiscal monitor, he said, do the spending you need to do, but keep your receipts, which is it's very, very important at this time to have clear accountability of the spending being done, clear transparency of the spending being done, both on the balance sheet and off the balance sheet, so that one can tackle this once you're past the peak of this crisis.
Okay, fair enough. I have one last question, and that has to do with China. The highest return to growth you've projected for 2021 is for China, over 9%. Can you talk us through that estimate? Will it be a largely domestic market driven growth. And I think implicit in my question also then is, what kind of international trade will we be looking at maybe in 2021? What have you factored into your forecasts in terms of the return to any kind of normal for international trade?
So in the case of China, that's the country where we've seen the biggest, strongest decline in cases. And most of the epicenter of it was in Wuhan, and the severity of it wasn't there in the rest of China. So they're much more quicker in the recovery phase as opposed to other countries where the second quarter is going to be the worst for them this year. That's one of the factors that plays into why we can see a little bit of stronger recovery in China. Second is very strong fiscal and monetary policy support that's in the system in China. And in additional, we can see China has the fiscal space to do more to aid the recovery. So because of both those factors, I think you're right that we have one of the strongest recoveries projected for China. But again, we're not talking about a full return back to the pre-crisis level of economic activity. And secondly, as long as the rest of the world is in a lockdown and there's weak demand in the rest of the world, the spillover from negative global demand on China will also be significant.
All right, Gita, I know we're at the end of our time, and I appreciate the patience you've had through all my questions. Thanks very much, and thank you for speaking to BloombergQuint. Stay well.
Thank you.